Welcome back to Economic Outlook. For many people, the financial crisis from 2007 to 2009 remains difficult to understand. Today I want to explain one aspect of the crisis: mortgage-backed securities. Mortgage-backed securities and their derivatives, collateralized debt obligations, were instrumental in the fall of Bear Stearns and Lehman Brothers. They also prompted the government's $700 billion bailout package. I want to explain how mortgage-backed securities contributed to the collapse in our economy. To understand the origins of mortgage-backed securities, it's important to know how the process of mortgage lending has changed over time. Traditional mortgage lending was straightforward. A mortgage represented a stable monthly cash flow. Banks could value or discount these fixed income cash flows relative to market interest rates and the risk of early repayment. The bank also weighed the creditworthiness of the applicant to determine the appropriate interest rate to charge for the mortgage. This made mortgages a profitable and low-risk activity for banks. The mortgage was a safe investment because the security, the mortgage loan, was collateralized by a tangible object, the buyer's house. If the buyer defaulted on his or her payments, the bank could sell the house and recoup its initial loan. Banks also required minimum down payments to further offset the risk of non-payment. Mortgages represented a long-term commitment between a bank and a homebuyer. The profitability of the mortgage depended upon judicious pricing and an accurate assessment of home values in case the buyer defaulted. This dynamic began to change in the 1990s. Low interest rates and soaring home values created a new paradigm for lending. Increasing home prices and low interest rates created the conditions for subprime lending. The U.S. Census Bureau reports that levels of home ownership rose from 64% of the general population in 1994 to a high of 69.2% in 2004. Much of this increase is directly attributable to the increase in subprime lending. As home prices increased, so did speculation and investment. Home purchasers bought homes at higher multiples to their annual gross incomes. People took out additional loans to fund home improvements or make other discretionary purchases. Lenders began to relax credit standards, and buyers were able to take advantage of adjustable rate mortgages and teaser rates. Some home buyers would buy homes without putting any money down, or would pay interest-only loans. As more money poured into the housing market, prices steadily increased. Purchasers of adjustable rate mortgages, or people who put little to no money down on houses, were able to capture the value of rising home prices by selling their property or refinancing their homes at more favorable interest terms. Between 1997 and 2006, home prices increased by 124% in aggregate across the United States. This increase is directly attributable to the rise of subprime lending. As more subprime homebuyers began to purchase homes, the aggregate demand for housing increased and prices went up. As more prime borrowers began to take advantage of lower interest rates, more and more people spent more and more money on housing. As long as prices continued to increase, consumers were insulated from the ramifications of taking out more risky loans or putting down little to no money on houses. This type of lending would not have been possible under the traditional bank-homebuyer relationship. Increasing use of securitization caused a new paradigm for banks, lenders, and powerful institutional investors who wanted to take advantage of the housing market's robust annual return. Subprime lending was limited under the old bank-buyer relationship for two reasons. First, subprime lending was far more risky than traditional prime lending. Subprime borrowers were more likely to default on their payments, and banks would be forced to seize the house and sell it on the open market. Banks don't want to do this because it involves price risk if the value of the house declines before the bank can sell it. It also deprives the bank of the interest rate payments that actually made the loan profitable in the first place. A second concern is that banks simply did not have the cash outlays available to lend to subprime consumers. A typical mortgage created a 30-year relationship between a consumer and a bank. A bank had to make a substantial cash outlay at the beginning of this relationship and receive repayment over a long period of time. Banks simply didn't have the capital resources to make all of the loans they might want to. For example, banks would have a fixed amount of capital at a certain risk level that would be allocated for prime mortgages. Banks simply didn't have the capital available to enter the subprime market, and even if they did, they found that there were better alternatives for the same level of risk that subprime mortgages entailed. Increasing use of securitization solved both of these problems and changed the way banks lended money to consumers. Mortgages represent a series of cash flows. If mortgages are pooled together, they resemble a standard bond. The pooling of mortgages is a kind of securitization. Debt instruments, in this case mortgages, are aggregated and a new security is issued to investors. There are three major companies which buy mortgages for securitization. The first is the Government National Mortgage Association, or Ginnie Mae. The second is the Federal National Mortgage Association, or Fannie Mae. And the third is the Federal Home Loan Mortgage Corporation, more commonly known as Freddie Mac. When one of these companies, or a private counterpart, purchases a mortgage from a bank, it solves the two hindrances to subprime lending. The bank is able to immediately make a profit on the sale of the mortgage. It also receives the money it needs to lend to another customer. This gives the bank the capital resources to lend to both prime and subprime borrowers. Companies which buy mortgages from banks pool the mortgages together and sell the pools to willing investors. These investors receive the mortgage-backed security, or MBS, which behaves like a bond. The investor receives the pooled monthly payments, just like a bond coupon payment. This process creates a cycle by which banks' resources are continually replenished. The issuer buys the bank's mortgages and sells the mortgage-backed security. The issuer can then purchase more mortgages and repeat the cycle as long as there are willing buyers for the mortgage-backed securities. This process is not accidental. The U.S. government established Ginnie Mae to help banks issue more mortgages. A mortgage-backed security issued by Ginnie Mae is backed by the full faith and credit of the U.S. government. Essentially, the government guarantees the monthly payments to the holder of the mortgage-backed security. Fannie Mae and Freddie Mac do not receive the same explicit support, but each has privileged access to U.S. Treasury loans. Many purchasers of mortgage-backed securities have assumed that Fannie Mae and Freddie Mac are actually guaranteed by the government. In practice, the government has shown that it's unwilling to allow either of these institutions to fail. All three have the de facto support of the federal government and the U.S. Treasury. This makes mortgage-backed securities especially attractive to investors, since the securities' coupon payments are guaranteed. The same guarantee does not apply, however, to private issuers of mortgage-backed securities. From the consumer side, the shift to securitization was hardly noticeable. Homebuyers would still receive a mortgage and make monthly payments to a loan servicer. The servicer would forward the monthly payments to the issuer of the mortgage-backed security, who would then make payments to mortgage-backed security investors. The most noticeable change for consumers was the rise of mortgage brokers and the originate-to-distribute model of loan generation. Once investors began to purchase mortgage-backed securities, banks were able to lend to more consumers. Mortgage brokers emerged to help match borrowers with banks willing to lend. Brokers earned a commission on each loan he or she generated. This created a unique alignment of incentives, which pushed both banks and mortgage brokers into the subprime market. Both parties made more money as mortgage generation increased. Banks were able to lay off risk to the issuers of mortgage-backed securities, and mortgage brokers realized that subprime borrowers represented a vast, untapped market. The incentive structure became predicated upon origination and transaction volume rather than on proper risk control. Rising home prices further fueled lending. The system created a classic bubble which fed upon itself as prices rose and lenders looked further down market with more exotic and risky products like interest-only loans and introductory teaser rates. In my next entry, we'll discuss mortgage-backed securities in more detail, and we'll look specifically at their derivative instruments, collateralized debt obligations. Thanks as always, and be sure to visit my website, www.econoutlook.com.